Mark, let's talk about the markets in 3 minutes then. And let's start with, as Tom was rightly pointing out, this sort of different stock environment that we seem to be seeing at the moment. We've had strong data and we just don't seem to be, as investors, or the investment community just does not seem to be as nervous as it was about higher interest rates following that strong data. I wonder what you think of that dynamic, Mark.
I think it makes sense. Look, ultimately, stocks should be happy about a strong economy. And at the moment, we're basically getting a message from the economy like, hey, these interest rates aren't overly restrictive just yet. They are not slowing down spending from the consumer, which is what drives the US economy. So I think we've been in this environment since April. In fact, we've been in this environment longer if you take out that very important exception around banking turmoil that kind of broke everything temporarily in March. But since then, since maybe mid-April, we've been back in this environment that, hey, consumer is strong. They weren't worried by the banking turmoil too much. This means more rates have to get priced back in. We talked lots about this year, about how those rate cuts just seemed nonsensical and there was no justification for being priced in the curve. We've now priced out those rate cuts and the stocks are going, hey, look, we are still getting a rates market which is pricing in cuts which don't seem to be warranted. This is still a supportive market for stocks. That will end at some point, but not anytime soon. I think this positive environment for stocks overall lasts for at least another 2 months.
It seems interesting then that expectations on the other side around the possibility of peaking on rates in Australia are driving assets there. So we've got the Australian dollar down, we've got Aussie bonds higher. As a result of the market asking itself questions after the recent inflation print, will we get more hikes? Or at least is the last hike, is it going to be delayed from the RBA? That seems to be a really interesting dynamic when it comes to inflation, this miss.
Yeah, I'm great. I'm pleased you kind of drew attention to that because I think this is a very important global phenomenon. Every time we see a sign that maybe inflation is falling really fast or much faster than we want, we see bond bulls pile in. That's been the theme of the last kind of maybe 8-10 months. This idea that people really want to trade the idea of a rapid pivot in yields as soon as the data allows them. And that's why it's a good backdrop for equities, because equities are saying, hey, the data's holding up even with these rate hikes. And if you're suddenly going to offer me rate cuts, the first sign of weakness, well, then that will ease the background for stocks as well. So overall, it's a very, very positive skew for equities until we actually get the recession, which I think is going to come much later, but be harder than many people think.
Do you think the headlines around the US curbing chip exports to China, well telegraphed as they have been, Mark, do you think they should have any kind of, give us macro pause for thought, given we talked yesterday about how the growth narrative out of China is just so important for the West?
I mean, yes, except, I mean, absolutely, this is very, very important. I mean, it plays into the China growth story, the US growth story, the trade story, the geopolitics story. So, yes, this is absolutely most important. It is the world's 2 largest economies, the pillars of the global economy here that's going to drive things. The only reason that I massively discount that is because it has been so telegraphed. We knew it was coming for a long time, and therefore this is not a shock, this latest development.